Good morning, everyone, and thank you for joining our webinar this morning. We are here for an introduction to carbon accounting and Scope 3 emissions. Just some housekeeping before we do get going. Please mute your microphones to limit disruption throughout the session. If you are not speaking, please turn off webcams to improve video quality. Please do ask questions using the Q&A function. We will try and answer questions as we go, and any we don't get round to, we'll try and answer at the end. And just note that the webinar is being recorded and the slides will be shared with you afterwards. To familiarise yourself with the speakers today, we're joined by Jess and Maya from Ramboll, and myself and Lisa from Talan. And with the agenda, so we'll start with just a very brief introduction from myself, and then I'll hand over to Jess and Maya from Ramboll, and they'll be given an overview of Scope 3 emissions and data sources. They'll then hand the baton over to Lisa about 20 to 11, and she'll be running through Scope 3 measurement in practice for heat network stakeholders specifically, and then we will have that dedicated time at the end for the Q&A. So just a quick introduction, why are we here? So we're here, one of the reasons is to meet our social value commitments through the HNES scheme. So both Talan and Ramboll have committed to support decarbonisation through the delivery of the heat network efficiency scheme contracts. And one way to do that is to provide applicants, so yourselves, with information, advice and guidance on measuring and potentially reducing your carbon emissions. So the aims of the session today: one, to support the objective of the HNES scheme to reduce the carbon impact of heat networks. Of course, to reduce carbon, you first need to measure it. Secondly, to support the evidencing of carbon reduction achieved over time and through the HNES scheme. And finally, to improve the carbon literacy of the heat network supply chain. We're also here because we know it's important to you. We always survey people when they register for this session. We've run it a few times now. This will have been sent to you if you signed up after, I think, the 7th of May. So over half of you said that you were either slightly or not at all familiar with Scope 3 emissions. So hopefully this session will provide you with some confidence today. And 60% of you said you either are slightly or not at all confident in your understanding of quantifying Scope 3 emissions. Okay, so I'll now hand over to Jess and Maya from Ramboll. Just hoping they are on the call because they did have some tech issues before we got going.
Yes, I'm here.
Thank you, Maya.
Just waiting for Jess to join. Let me see if she... Just a moment.
Hopefully she'll be here in a moment.
Apologies, yes, I will message her quickly, see what's happening.
She had the same issue as you, Maya.
Yeah.
So yeah, they're all important restart message just before a webinar. So it's worth mentioning that some of you may have joined this session previously, so hopefully it will provide you with a nice recap if you have joined before. And we'll also be running Scope 1 and 2 emissions webinar towards the end of the year, as well as another Scope 3 emissions webinar, because we know that one is the more complicated one.
Sorry, I've been struggling to get through to Jessica.
Do you think you're able to deliver some of Jessica's slides, Maya?
Yeah, sorry. We can give it a go, maybe.
Okay.
Yeah, I haven't run through all the slides, but I can give you an overview thinking of what the Scope 3 emissions are. So as you know, the Scope 3 emissions are the most challenging of all scopes that we are facing as a company, because a majority of companies' emissions land in Scope 3. So these are 90% of emissions. But the reasons why they're so difficult to evaluate, because they result from activities that are not owned or controlled by the organization, much differently compared to Scope 1 and Scope 2, which are much easier for a company to evaluate. Scope 1 are direct emissions that occur from sources that are controlled or owned by a company. So easy way to think about it. It's thinking about the things that you burn, such as heating, fuel for your vehicles, while Scope 3 are all those indirect emissions associated with organizations' energy. So the electricity that you purchase, steam, heating, or cooling. Next slide, please. Why do we need to calculate them? Because, as I mentioned previously, 90% of companies' emissions lie, not of all companies, but majority of companies have between 70 and 80% of their emissions in Scope 3. If we manage to tackle down and estimate with greater accuracy these emissions, that would enable huge cost savings and efficiencies being made. It would enable us to set accurately reduction targets. Many of the companies will be expected to set up their science-based targets in the future, as we're approaching the net zero 2050 goal for the UK. And it would also enable us for a better risk management and reduction opportunities being identified. Next slide, please. As you can see here, the Scope 3 spans across 15 different categories. We can separate them in upstream categories. Jess, okay. Hello, Jess. I think Jessica just joined in.
Hello.
Hi.
Can you hear me?
Hello. Yes, you had some connection problems.
I'm so sorry about that. It's always great when your computer decides to start updating at 10 o'clock when you're about to start a presentation. So I'm here now. But yeah, thanks, Maya, for starting things off. Did you get to the end of
I
this
got
slide?
to this slide here if you'd like to take over.
Okay.
It's just at the beginning of this slide, Jess.
Okay, great. So this kind of just gives an overview of the 15 categories that fall under Scope 3. So it's split into upstream and downstream categories, and we will go through each of these in the presentation today to break it down a little bit more, just to make it a little bit clearer. Upstream categories are typically associated with the extraction of raw materials, the production of energy and fuel, and also the production and transportation of products, amongst many other things. Downstream is associated largely with kind of end-of-life scenarios, thinking about the waste disposal and also the kind of transportation of products that you might have sold as a business or company, and the investments that you have made as well. If we go to the next slide, please. So this slide just illustrates why Scope 3 emissions are really important to capture, because they do tend to represent the greatest share of emissions. So this bar chart here, you can see is the spread of emissions across different sectors and different scopes. So scope 3 is the orange bar that you can see, and for most of the sectors, you can see that it's the majority contributor with an average of 75% of total emissions. So you can see it's very material to try and calculate, even though it does tend to be the trickiest thing to gather the data for and actually quantify these aspects. We go to the next slide. So one of the things we just wanted to touch on as part of this presentation was the update to the GHG protocol. So typically when you're doing your carbon accounting for scope 1, scope 2 and scope 3, you would follow the GHG protocol, which is a set of standards that outline how you would quantify these different elements, and the GHG protocol essentially feeds into a lot of other reporting frameworks like CSRD, ISSB, things like that. They all kind of rely on the GHG protocol as the kind of basis of these reporting standards. So at the moment, the Scope 3 process is being updated, and there's consultation periods coming up, I believe later this year. They have given some indication as to what some of the changes could be, some of the key changes. However, the expected rollout of this would be from 2027 or 2028 reporting year. There has been no mandatory adoption transition period specified yet, so it probably will be the case that this will be kind of a transition phase from those years rather than kind of straight away in 2027, 2028. So if we just go to the next slide, we'll just touch on some of the main changes just to make you aware. So as I said, this won't really be affecting you right now, but it will need to be a consideration for your business soon in order to prepare reporting and you're also the data collection to align to these new kind of changes that are happening in scope 3. So one of the main ones is around companies must now report at least 95% of their total required scope 3 emissions. So the remaining 5% can be excluded, but only if it is minor sources. So prior to this change, companies had to account for scope 3 emissions and justifying exclusions, but now a threshold is put in place of that 95%. And to be able to exclude something if it's a minor source, you have to be able to prove that it's a minor source. So in that sense, you almost have to kind of do a very high level quantification of those minor sources to be able to prove that. So that is just another kind of set of data that will need to kind of be gathered and kind of looked at a higher level to prove that you don't have to kind of go take that further step and quantify as part of your scope 3 coverage. Then there's a new category 16. So this covers the facilitated emissions. These are third-party activities which generate emissions that a company earns income on, but they have no control over that specific activity. So there is kind of more robust reporting on this, and that's why it's being separated into a new category. This, however, will largely be applicable to financial platforms or kind of marketplaces rather than kind of other types of businesses. And then the third main one is the revision of the data quality requirements. So now companies will be required to disaggregate the emissions into distinct tiers by data type for each of the categories. So they want more visibility and transparency on the data sources. So we'll have to break down the data from primary sources, secondary sources, supplier inputs, if it's an industry average, if it's from a spend-based. And this is just so that they can compare companies easier, as the data quality that is going into those assessments is a bit more transparent at the reporting level. If we go to the next slide, please. Thank you. So we're also just going to briefly go over the reporting cycles for GHG accounting. So we're kind of going to start at the top here. So defining the boundaries. That sometimes this can be a really complex exercise, and it's very important to get the definition right at the start. It can become complicated when assets are owned by a company but then operated by another, or also if heat is purchased via different arrangements. And this is when you start to look at the kind of operational control versus equity share versus how contracts are set up. And that's how you kind of define emissions into those different categories. I think Lisa is going to go into this a little bit deeper later on, specifically for heat networks. So the kind of next steps after you define the boundaries is to gather the data and calculate those emissions from the data in line with the categories of the GHG protocol. These results can then be analysed and you can put together a carbon management plan. This can be defines how you will reduce your emissions and manage that kind of carbon reduction over a time frame. And typically this is when you would look to set any targets if that's something that you would like to do. An option is then to kind of publicly disclose these results. This is not mandatory. However, as mentioned before, the GHG protocol and the kind of GHG accounting exercise can be used as the basis for disclosures like CSRD and ISSB, CDP, things like that. So if your company is required to carry out those disclosures because it's of a select size, or your investors, stakeholders are making that mandatory disclosure, then you would essentially use your results from this kind of exercise into that. After that, then you would follow your carbon management plan and then continuously improve on the results. And also, as you're kind of going through this cycle, your data quality and collection would get better as you kind of get more mature in your carbon accounting. And then you would then report against your targets that you set in as part of your carbon management plan. I think we'll go to the next slide. So now we're going to just go through each of the 15 categories individually to give an overview. So we're going to run through the details, the data requirements, the units, and some of the key considerations for this. And we're also going to provide a few examples for a few different types of businesses. As mentioned before, the boundary setting is quite nuanced for each company or business. So what to include and what not to include can depend on each company. So this is just some kind of typical examples, but they're not exhaustive by any means. So yes, this category 1 is purchase goods and services. This is the first category in the upstream emissions. And these are the emissions from the production of products purchased by the company. And so these are typically operational purchases of products. So this could include things in the goods category, such as your office and lab consumables, software, or your water consumption. And for services, it may include kind of legal, cleaning, maintenance, or even external consultants, if that's something that you have. If you are just starting out, spend-based data is likely the most achievable, as this can be accessed through an OPEX report. But once you have done a few GHG accounting cycles and it becomes a bit more mature, businesses tend to move towards supplier-specific embodied carbon data where possible. So this is kind of looking at more activity or supplier data with actual quantities of that. But spend data is fine for category 1. Key considerations for this category are that the spend needs to be disaggregated as much as possible so that you can assign the emission factors for each of the different goods and services that you use. So this shouldn't include things like salaries, rent, tax, or anything that would be included in other categories such as fuel or electricity. And then water data is preferred in the activity data, so looking at the actual consumption, so kind of meters cubed or liters of consumption. Just to run through a few examples at a high level. So for someone like a social housing provider, this can include things like tenancy cleaning services, white good appliances, or any furniture. For local authorities, this could be uniforms, safety gear, maintenance, NHS trusts. It could be medical supplies, medical equipment, also safety gear, again, any consulting services. And then for kind of heat network operators, this could be kind of facilities management, any IT services, chemicals, PPE, water consumption, as mentioned. So it kind of covers quite a wide range of those purchased goods and services. Just go to the next slide. So this is category 2. So this is capital goods. It is calculated similar to category 1, but these are the production of capital goods purchased by the company. Capital goods are treated as fixed assets or as plant, property, and equipment. So to be a bit more specific, this is things like machinery, vehicles, materials, or equipment, such as IT equipment, for example. Like category 1, financial data can be used, like the CapEx report, but then as you start to get more mature, you can start to use activity data if you have that, or supplier data. Similarly, the spend is to be disaggregated as much as possible so that emission factors can be assigned accurately. And then some examples of this for local authorities is any construction or maintenance of housing, repairs to roads. In terms of NHS Trust, this could be some of the medical equipment, so the kind of MRI machines, any sort of construction, if you're doing any IT systems or upgrades of infrastructure. And then for heat network, this can be things like your equipment, substations, boilers, any kind of pipework, pumps, and then kind of materials for construction as well. So this is kind of a lot of your embodied carbon for construction comes into this category here. Go to the next slide. So this is just to give you an idea of the emission factor categories available for spend data for category 1 and 2. So here they have kind of goods and services in these two tables here. So services on the left is mentioned before, things like accounting services, any sort of kind of cleaning services, financial services, maintenance services, and then goods on the right is more of those kind of furniture, equipment, paper products, computers, things like that. If these kind of spend data is what is kind of most common at the early stages, and then some of the sources that you would look to for these would be DEFRA, ICE, and then as you kind of get more developed, you can kind of start to look at EPDs for particular products if you know the products that you'll be sourcing. So when you're kind of looking at doing your data collection, you want to gather data with these categories in mind and make sure that you're kind of aligning it with these. If we go to the next slide. So this is category 3. This is the fuel and energy activities, and it's the upstream emissions of the purchased fuel and energy accounted for within your scope 1 and scope 2 emissions. So scope 1 and scope 2 is only looking at what you have consumed on your site, whereas this is the upstream emissions related to that for the extraction, refining, generation, and transportation of that energy and fuel that you have consumed at your specific site. So typically you would utilize the data that has been laid out as part of scope 1 and scope 2 reporting here. This can usually hopefully be activity data. So if you have kind of your liters of fuel or your kilowatt per hour of electricity or refrigerants as well, then you can generate the emission factors for each of these, and that will kind of allow you to measure these the upstream impacts of the fuel. So yeah, some examples of these are kind of fairly similar across all the different types of sectors here, but it's kind of emissions from any boilers, electricity, cooling used for heating units, or any sort of electricity heating used in offices, anything to do with fridge or freezer units. So that's where your refrigerants come in, electricity for pumps, things like that would be accounted for as part of this category. So I think I'm going to pass over to Maya now to just go through the rest of the categories.
Thank you, Jess. So yes, we are moving on to category 4. This relates to upstream transportation and distribution. So these are the greenhouse gas emissions associated with third-party transportation and distribution services that the reporting company purchases during the reporting year. In simple terms, this is really about the transportation of goods that your organization has purchased. So things like courier and logistics services. The data requirements we typically look for here would include things like the distance traveled and the transport mode used, or alternatively, the fuel consumed and fuel type. We can also accept secondary data. So if activity data isn't available, which often won't be, financial data showing spending can also be used. A few key considerations for this category is that transportation emissions linked to purchased goods may already be included within category 1, and supplier data can sometimes be difficult to obtain. So it's important to dissociate the purchased goods emissions from the transport emissions. Important to allow enough time to gather this information when you're carrying out an inventory. As an example of how this could work in practice for social housing providers, that would be delivery of construction materials for housing developments that we would be considering, transporting household appliances from manufacturers' housing units, any logistics involved in the maintenance and operations. For local authorities, this might include deliveries of maintenance materials from manufacturers to housing units, as well as office supplies and equipment delivered to different local authority offices. And for NHS Trust, this could include deliveries of medical supplies, equipment, and pharmaceuticals from suppliers to hospitals and clinics. Next slide, please. Then we have category 5, which relates to waste generated in operations. So this covers greenhouse gas emissions from waste generated during the reporting year. Examples here could include waste disposal from renovation projects, waste from provider offices, housing estates, or tenant homes. In terms of the data requirements for this category, these can vary, but ideally we'd want information on the type of waste. So for example, you would like to know if we're talking about the general waste or hazardous waste alongside the quantity or volume of waste and the disposal methods used. So it's useful to know whether waste is landfilled, recycled, or composted. And again, if that data isn't available, we can also accept financial data showing spend on waste management, which is often used as well. So some key consideration here are that a quantity and type of waste are particularly important. If disposal matters aren't available, we can make assumptions also using industry benchmark. Spend data that we talked about will usually come from invoices from waste disposal companies, and information can often be sourced either from waste providers or financial records. So for in terms of applicability on different stakeholders for NHS Trust, for instance, specifically this category could include clinical waste, pharmaceutical waste, hazardous waste. This is typical because you don't see the type of waste across many other stakeholders. Because NHS has a lot of laboratories, so they are dealing with specific types of waste for that. Any defective medical equipment would need to be included, and medical devices that were disposed of during the reporting year. Next slide, please. Then category 6, we have here the category related to business travel. This includes emissions from transporting employees for business-related activities that could include travel by plane, train, bus, tram, or passenger's car, as well as traveling in employee-owned vehicles where mileage is expensed and taxes too. For data requirements, we'd usually look to understand the travel mode, the distance that we traveled, or the fuel consumed. And in case that information isn't available, we can also accept, as usual, the financial data that I was mentioning, which shows spend by transport mode. So one important thing to note is that this category includes all modes of transport. The examples listed here aren't certainly exhaustive. Spend data would simply be the cost of the transport, such as taxi fares or train tickets, and this information can usually be sourced either from travel providers or financial records. So examples of this might include for social housing providers, that might include travel from maintenance offices to housing units, property inspections or visits to development sites. For local authorities, this could mean including staff and consultants traveling to meetings with contractors and architects or attending conferences and events. And for NHS trusts, this might include travel between different hospitals and clinics for inspections, meetings with healthcare providers and contractors, or attendance at healthcare conferences. Next slide, please. Then we have category 7, which relates to employee commuting. So this is exactly what it sounds like. It's emissions from employee traveling between their homes and workplaces. This includes commuting by car or any other form of transport. The type of data we'd usually look for here is mainly activity data. So we'd want to understand things like the number of employees at each office or site, the number of days employees worked from home, the main transport modes used, travel distances per employer or office location, and annual working weeks or days. So a key consideration for this category is that the more activity data you can provide, the more accurate the results will be. But if some of that information isn't available, we can use a combination of actual data and averages based on desk-based research. So data for this category often comes from employee surveys, HR records, or assumptions made about staff travel patterns. Examples could include emissions from employees traveling to work by car, public transport, cycling, or walking, and this would cover both on-site staff such as property managers and housing officers, as well as employees working in administrative roles within local authority offices. Next slide, please. So as mentioned in the previous slide, first choice data would ideally be detailed activity data, but second choice data can use averages instead. So for example, you might provide a number of employees per site, perhaps 30 full-time employees at the main office, and the average number of work from home days, the transport split, such as 50% traveling by car and 50% by train, which is often the case, average commuting distances, and annual working weeks. And if you want to have a more high-level estimate because you can't get all that data, you might simply provide the number of employees at each office or site alongside the number of days employees work from home. Even though it's less accurate, this kind of analysis is still valuable enough to work with. Next slide, please. Then we move on to category 8, which relates to upstream leased assets. So these are emissions from assets leased by the reporting company during the reporting year that are not already included within Scope 1 or Scope 2 inventories. In many cases, this data is already captured within Scope 1 and 2, but if not, it would fall into this category. Typically, this refers to things like electricity use, fuel consumption, refrigerants, and services associated with offices or other sites where the organization doesn't have full operational control. For example, where you may not control the electricity provider. The data requirements here would usually include electricity consumption, heating fuel consumption, and refrigerant service and records for the areas where the company operates. If this data is not accessible, for example, if a landlord can't provide it, then floor area data can be used to estimate emissions instead. Next slide, please. So we're moving on to downstream activities. These are activities that occur after a reporting company has sold the product or a service. The first category here is the downstream transportation and distribution. So this relates to emissions generated from transporting and distributing sold products using vehicles or facilities that are not owned or controlled by the reporting company. In simple terms, this is a transportation paid for by your customers or clients. The data requirements might include fuel consumption, distance traveled, and vehicle type, but one important distinction here is that the reporting company itself is not paying for the transportation. If it were, it would sit under another category. So for social housing providers and local authority, this could include downstream transport and distribution linked to services delivered to tenants, for example, such as emergency call-out costs when tenants are locked out of their properties, or transportation of appliances, furniture, and fixtures to housing units. For district heat operators, this could include heat losses occurring while transporting heat from a central plant to end user. And for NHS Trust, this might include transporting medical equipment or pharmaceuticals to satellite clinics, delivering home care products to patients, or even patient travel to hospital. Next slide, please. So this infographic here simply illustrates the difference between upstream and downstream transportation and distributions, which may not be immediately intuitive. So the downstream applies when the company does not pay for transporting the sold product, whereas upstream applies when the company does pay for transportation. Next slide, please. This is category 10. It covers the processing of sold products. This would include emissions resulting from sold products that require further processing, transformation, or incorporation into another product before they are used by the final consumer. Relevant data here might include electricity and fuel consumption associated with that processing, A key consideration is that this category only includes emissions from third-party processing of intermediate products after they've been sold by the reporting company. The relevance of the category will vary depending on the organizations involved, but the main question is whether any sold products undergo additional processing before final use. For social housing providers, local authorities or NHS trusts, this category may only apply if physical products are sold that require further processing. For example, social housing providers might sell surplus construction materials, or they might sell waste for processing by another organization, while local authorities or NHS trusts might sell recyclable materials or decommissioned equipment for refurbishment or further processing. Then we have category 11, which relates to the use of sold products. This covers emissions generated during the use of goods and services sold by the reporting company. Data requirements here could include electricity, fuel, and gas consumption. This category is very much relevant where sold products generate emissions during their use phase. So organizations are required to report direct use phase emissions, while reporting indirect use phase emissions is rather optional. For social housing providers, local authorities, this could include housing units sold under right-to-buy schemes, where emissions rise from electricity and heating use in those homes. For NHS trusts, this could include diagnostic machines sold to other healthcare facilities, or medical devices provided to patients that require energy to operate, such as, for instance, hearing aids, blood pressure monitors, or ventilator used at home. These are those most commonly used for. Next slide, please. So here we can see the category 12, which relates to the end-of-life treatment of sold products. This includes emissions generated from the disposal of or recycling of products once they are no longer usable. The data requirements might include the total mass of sold products and packaging at the point of sale, along with the production of waste treated through different methods, such as landfill, recycling, or specialist hazardous waste treatment. Again, if this data is not available, financial spend data can also be used. Key thing to remember is that this category captures the expected end-of-life emissions from sold products, which is separate from waste generated in operations. The two are often confused, which is why it's important to point it out. And for social housing providers and local authorities, an example might be emissions associated with disposing of district heating infrastructure, such as heat exchangers or piping. For NHS trusts, this could include recycling or landfill treatment for diagnostic machines, surgical instruments, or PPE at end of life. And for energy operators, we would be thinking about emissions associated with disposal and recycling of solar panels, wind turbine blades, batteries, transformers, cables, and general electrical equipment. Next slide, please. Then we move on to category 13, downstream leased assets. These emissions here occur from leased assets during the reporting year, specifically Scope 1 and Scope 2 emissions from those leased assets. So the data requirements are again focused on electricity, fuel, and natural gas consumption. So this category is only relevant if your organization leases assets out to tenants who then consume electricity, gas, or fuel, which will then be your emissions as well. For social housing providers and local authorities, examples could include electricity and gas consumed within tenant homes, or refrigerants associated with supplied white goods like fridges and freezers. For NHS trusts, this might include fuel consumed by leased emergency vehicles, electricity used in leased NHS buildings or private healthcare facilities, or electricity required to power leased diagnostic machines, computers, or laptops. Next slide, please. The category 14 covers franchises. This may be less relevant for many organizations here, but it includes emissions generated from franchise operations that fall within Scope 1 and Scope 2. This category applies where companies grant licenses to other entities to sell or distribute goods or services in exchange for payments, such as royalties or trademark fees. The data requirements would again focus on electricity, fuel, gas consumption. For example, if a hospital operated as part of a healthcare franchise network, emissions from franchise operations will fall into this category. This is less common within UK healthcare settings, but it may apply in some cases, so it's worth mentioning it still. Next slide, please. And finally, we have a category 15, which relates to investments. This covers emissions associated with investments made by the reporting company during the reporting year. And for this category, you typically look at the electricity, fuel, gas consumptions of the investment companies, as well as the reporting company's equity share. One key point here is that emissions are allocated according to ownership share. So if you own 10% of a company, you would only account for 10% of its emissions. Insurance and underwriting emissions will soon move to category 16, and these are operationally different from financial investments, and this will happen once the Scope 3 protocol has been updated in the end of the 2027, as Jess mentioned earlier. But examples of the category 15 current application might include investments in district heating schemes for social housing providers or local authorities, or investments in medical research companies for NHS trust. Like mentioned earlier, we would soon expect also to see a category 16, which will be a new category for facilitated emissions, that we will be expected to report on from 2028, most probably onwards. And with that, we've covered all 15 Scope 3 categories. It can definitely seem like complex and daunting process at first, but the most important thing is simply to get started. So even if your data quality isn't perfect initially, which won't be, estimates can be made using financial data and then improved over time as better information becomes available. So there are also plenty of resources and support options available to help organizations on their Scope 3 reporting journey that you can use. And you can start from there. But this brings me to the end of my section of the presentation. I will hand it over to Lisa now, who will talk through Scope 3 measurement practice for heat network stakeholders.
Thank you, Maya, and morning, everyone. So what we're going to do now is move from the theoretical overview of the Scope 3 categories that Jessica and Maya just walked us through into something more practical. So we'll walk through a couple of examples with different ownership structures, and we'll discuss how emissions impact flows across the different stakeholders involved. So to set the scene, what you can see here is a basic illustration of a district heat network. We'll use this as a reference point for the different examples that follow, but now the idea is that could represent a range of setups from a communal network for housing estates to a wider district system serving multiple buildings. So the idea here is really to think about the broader picture that is the starting point for your carbon accounting, and we'll use that to identify how emissions are generated and reported across a district heat network system, regardless of its exact scale here. So we can begin with, you can go to the next slide, please, Christina. Thank you. So one of the things that make heat networks particularly complex, and I'm sure that you are aware of that, is the variety of ownership models that we can have. So as you can see on this slide, there is a range of stakeholders involved across the primary, secondary, and tertiary elements of a heat network. So today we have a number of ownership models that typically can revolve between the landowner and leaseholder of the location of the energy center, which could be a local authority, an NHS trust, a housing association, and so on. And you may have also involvement from investors, lenders, ESCOs, and energy suppliers. And on the consumer side, we tend to see similar types of stakeholder to those who own the properties. So again, we have local authorities, housing association, and similar bodies. So what we've done here is lay out a range of ownership configurations. So this is certainly not exhaustive, but the idea is to give you an idea of the spectrum. So at the top of the table, for instance, we have the simplest model, if I can say. So we have a single entity that owns and operates everything in-house. And if we go all the way down, we have a much more complex structure where the whole heat network is set up and invested in a special purpose vehicle or a joint venture, which is fully operated here by a NESCO under an energy performance contract. And of course, there are many combinations in between that you must be aware of. So why does this matter for scope 3 and why we wanted to show you that is that understanding your contractual arrangements, so who owns the assets, who operates them, who purchases the fuel, is absolutely key when you're thinking about the GHG emissions reporting and your responsibility for that reporting. So that is key to determine who is responsible for reporting which emissions. And that is what we're going to discuss with the next slide. Yeah, thank you. So there are essentially 3 different reporting approaches identified in the greenhouse gas protocol. The first one is the equity share approach. So this is relatively straightforward. The idea is that you report emissions based on how much equity you have on an asset or a business. So if you own, for instance, 60% of an asset or a business, you would account for 60% of the emissions arising from this asset, and the other party or parties that holds the remaining 40% will account for the rest. And the 2 alternative approaches are here based on the level of control, because you can have an equity share in a business or an asset and yet have no financial or operational control over it. So when you do have control, whether it is financial or operational, that is often the preferred method for reporting. But now, of course, there is a nuance between financial and operational control. For example, it is entirely possible that a local authority has financial control over an asset, but that the day-to-day operations are managed by a separate actor. So the local authority here in my example might be able to influence some of the financial flows related to that asset, but it may have no operational control over the buildings or the equipment. So in that situation, you end up with 2 organizations with different reporting approaches. And for a comprehensive and a non-double counting inventory, it is absolutely key that those entities communicate with each other and agree on who reports what under which approach. So it can be a tricky situation. In practice, organization will generally pick the approach depending on what is the majority type of control or equity model they operate within the company. And I'll be honest, this can get complicated to define on which asset I have financial control or not, for instance. So when it does get complicated, we typically lean on our financial colleagues and on financial reporting standards such as IFRS to clarify gray areas. So don't make this decision alone, but make it consistent with your the organization of your organization. We can go to the next slide, please. Thank you. So yeah, with that context in mind, we'll go through a couple of examples of typical heat network efficiency scheme projects. And our first example is a relatively simple in terms of ownerships to begin with. So let's say here that we have an NHS trust that operates a district heat network, and that the maintenance of that system is done by an O&M contractor. But the NHS trust is the one purchasing the fuel source and the gas, and it also owns the heat network that we are talking about. Now the revenue from the heat, which might be sold externally to residents or a housing association, is also retained by the NHS trust. So here the ownership and operational responsibilities are quite clear. since there are not that many stakeholders involved. So we can look at what happens for scope 1, 2, and 3 emissions for both stakeholders when that water pump gets replaced. So we can look at it in the next slide. Okay, thank you. So here we can see the emissions impact in year 1, so the first year after the water pump has been replaced. So we'll look at it for NHS Trust first. First, there are scope 3 category 3 fuel and energy-related activities will reduce because, of course, by installing a more efficient pump, they are reducing the amount of upstream energy required to bring fuel into the system. They will also be reducing their scope 1 emissions, assuming, for example, that the energy center runs a combined heat and power plant. They will be reducing their gas consumption. They will be also reducing their scope 2 emission because the new water pump, we can assume, is more energy efficient than the old ones. However, one important point, the scope 3 capital goods reporting will be increased in year 1 because they are investing in a new piece of equipment, so the water pump here, which will then come with its own embodied emissions. Now we can look from the contractor side. So the contractor installing the pump will see increases across several categories, as you can see. So across purchased goods and services for the materials and components that they are bringing in for the installation. They will also increase their category capital goods for the water pump itself. They will also start reporting on use of sold products because the water pump will be consuming electricity during its operational life, so they have to report about it. And more broadly, the contractor would also be reporting on a range of activities directly related to this project. For instance, they will be reporting on business travel or fleet emissions since their engineers need to get to site. Here is a good example of the issue that we can have to determine which scope and category these emissions fall into. Because, for instance, if the engineers are reclaiming expenses, we are in the category 6 business travel. But if the company is using its own company-owned van or its own car, then depending on whether that is a fossil fuel vehicle or an electric one, they will report these emissions on scope 1 or 2. So there are a lot of topics that need to be discussed when identifying the categories you will be falling into. So we will also see for the contractor some increase in upstream transportation and distribution. So not just for the water pump itself, but also for all the other purchased materials that are being brought in to deliver the project. And there will be also waste generated in operation for all the waste on sites. And finally, on the right side, we can see that the consumer benefits, of course, from this change because the systems becomes more efficient, so their scope 2 emissions are reduced, and that is the same thing for the upstream energy-related emissions. So that is for the first year of reporting, and now if we look forward to future years, we can see that the NHS Trust see these emissions decreases for fuel and energy-related activities, scope 1 and scope 2. Of course, these emissions are maintained year on year. And for the other categories of NHS Trust, we can assume that the old water pump was fairly inefficient and required then a lot of replacement parts, and that the new pump is more reliable, then the trust will also see a drop in purchased goods and services and capital goods. For the contractor, the picture also improves, of course, because the new pump is more reliable and breaks down less often, so the contractor may need to come to sit less frequently, which then translates to reduction in business travel, fleet emissions, upstream transportation, waste, capital goods, and so on. And of course, on the right side, the consumer maintains their benefits, which means still lower scope 2 emissions and fuel energy-related emission. So this example really illustrates the importance of taking a life cycle view, because you can see that year one may show some increases in certain categories, of course, because there is a capital investment, but over the life of the asset, the net impact is clearly positive for all the different stakeholders. So now we can look at another example that involves a slightly more complex ownership structure that you can find more frequently. For this new example, we are looking at a heat interface unit that is being replaced. So as you can see on the graphic, the heat interface unit is in the secondary distribution area in the yellow box. But the ownership structure here is way more complex. So we can assume here that the base energy center is a joint venture between an investor and a local authority, and that it is operated with an ESCO under an energy performance contract, for instance, and that the maintenance of the whole system is also done by that ESCO. We can also assume here, as it is sometimes the case, but not always, that the ESCO is purchasing the gas and electricity required to generate the power for the system. And we will also consider that the heat network itself is fully owned by the local authority. And the revenue from the heat sold to consumer is split in 3 ways between the ESCO, the investor, and the local authority. So this type of arrangement is relatively rare of what we know, but we do see this complex scheme in practice, so they raise important questions about who report what that we will discuss just now. So we can move. Yes, thank you very much. Okay, so to analyze the different category of emissions, we can start with the local authority and the investor as the joint venture. So if they use equity share approach, they will split the emissions according to their respective investment and revenue shares, as we discussed earlier. But there is an important nuance here to identify which categories they need to report on. The question is, what is the nature of their relationship with the ESCO? If the local authority and investor are contracting the ESCO as a service provider, then the emissions will fall into the category 1, purchased goods and services. But if they are leasing assets to the ESCO, then they will potentially report under category 13, if I'm not mistaken, the downstream leased asset. So the idea here is that the same physical emissions can sit completely in different categories, depending on the control structure of your scheme. And this is exactly why understanding your agreements in detail is really important. And regardless of the specific arrangement here, the investor and the local authority will likely report under category 15, investment for the financial gain of this investment. And for the ESCO, now, since they are the one buying and burning the gas, they will have a reduction in scope 1 and 2 emissions because the new HIU reduce heat losses and reduce the needing of those fuels. They will also reduce the upstream fuel and energy-related activities. And potentially, if they are leasing the asset from the local authority or the investor, their upstream lease assets will also reduce. But since we are in the first year of reporting, as with the water pump that we just showed, the installation drives temporary increases in travel, upstream transport, waste, purchased goods, and so on. And for the consumer, here it is the same story. They benefit from the reduction of their scope 2 emissions and upstream fuel and energy-related activities. So we can now look forward to future years and to what will be the emissions. So we will have a similar logic to our water pump example. Since the investor and local authority continue to split emission in the same way according to their share in the investment, the ESCO maintains its scope 1 and 2 reductions, and as the water pump replacement, we can assume that the old HIU were requiring a lot of maintenance, and now we will have a decrease in then business travel, purchase goods and services, and so on. And of course, and this is really at the core of the heat network efficiency scheme, the consumer continues to benefit from the reductions of the project, and so it reduces its scope 2 emissions and the upstream emissions related to that. So I hope these two examples have been useful and make some sense for you. So of course, there are many types of technology that could be considered here, and so mainly there are any number of complex investments and ownerships model to consider. But the objective here is really to give you a way of thinking about how you might account for your emissions at the project level, and what are the things, the elements to think about. And one important point to note also is that the reason for looking at this example is not necessarily to say that the corporate level scope 1 and 2 and 3 report must include a project by project breakdown. But the idea here is that considering projects individually, alongside, of course, your corporate level reporting, but it will give you a number of advantages, and it starts to take your organization into a life cycle thinking, which is incredibly valuable for understanding your material use, your energy flows, and basically the total emissions impact across the life of a particular installation. So it will really help you to make some important decision for your future investment. And so speaking of these different opportunities, we can now go through the different challenges and opportunities that are involved in this type of reporting. I'm sure that you have already thinking about a lot of challenges here. So we will highlight a few key ones. So first, as we discussed earlier, there is a real challenge to identify boundaries because we saw that you can use different reporting approaches. And it is really important, essential to define where one organization's boundary ends and another's begins. So this really requires dialogue between stakeholders to avoid double counting emissions or missing them entirely. Another important challenge that has already been discussed by Jessica and Maya is the data quality and availability. So the level of data you have can really vary significantly depending on the activity and of the category we're talking about. For instance, for energy consumption, you may have detailed monitoring system with real data that you can use and that is really qualitative. But for categories, for instance, like business travel, you often rely on estimates where the data might not be that secure and direct. For instance, for business travel, you can use data, but it depends on whether you're using fuel cards or whether it's on an expense basis. So the data quality can really depends of your own situation. So one of the key challenges when estimating your carbon emission is dealing with different level of data maturity across the categories. Another important challenge is the stakeholder engagement. So you can imagine that to build a robust scope 3 inventory, you really need to understand what's happening across your value chain. So that is not the most common thought that we have. And so that requires to really open discussions with your different stakeholders. And that also requires resources and internal resources for having this discussion with your stakeholders, mapping the system, deciding who is going to report on what, how to ingest the data, report on it, and how to also make sure that the emission factors are annually updated. And another particularly tricky challenge, which is completely the center of all of this, is the knowledge of the methodology, particularly for compliant GHG protocol reporting. So it might be difficult to get all of this information and all of this knowledge, considering also that it is currently moving a lot. But there are also significant opportunities doing this work. First, new collaboration can take place And shared motivation between stakeholders can also take place to both see the results of the investment of the project that are being undertaken. Also, many of these projects sit within public procurement frameworks where you are increasingly expected to demonstrate the social value you are delivering. So an effective measurement of your scope 1, 2, and 3 emissions allows you the ability to report back on your social value. Also, by analyzing your emissions in more detail, you often identify new opportunities for improvement and then future projects. For instance, you can identify additional optimization projects. So that is really an interesting point. And also bringing this data together and being able to paint a picture of the effect of the whole project on the first year, but also, as we have seen over the time, will for sure deliver a positive communication about the project and the sector more broadly. And lastly, as you can see, increasingly financial flows are directed towards projects that deliver measurable green positive impacts through the UK taxonomy, but that is not the only regulation and frameworks that implies that. So the ability to communicate robust emissions data allows you to really demonstrate that impact and then can attract further investment into your project or your organization or even the sector, which can also help for us to advocate to government for increased fundings for this type of schemes and broader policy support. So this the reporting has really a lot of opportunities. So just to sum up, overall, while the scope 3 reporting can be really complex and we are really conscious of that, it really is a strategic tool to better understand your system, improve your decision making, identifying new projects, and unlock future opportunities. Krishna, I think your mic is off.
Sorry, thank you. So yeah, thank you so much to Jess, Maya, and Lisa for speaking today. The details for all of our speakers are now on the screen, so you can scan the QR codes, which takes you directly to their LinkedIn if you have any follow-up questions to them directly, and their email addresses are on the screen. So these slides will be shared as well, so you'll have that information to hand. Okay, so we'll now go to the Q&A. So I know that there's one question that's been asked in the chat that hasn't yet been answered, and it's to do with their participation certificate. I'm not sure who that's directed to, but if any of our speakers can answer that question, that would be great.
I'm not sure about that. I think that's something we would have to just double check with yeah, the kind of main organizers of this.
Okay, so we can get back to the person that asked that question. If anyone wants to come off mute to ask any questions, you're welcome to do so as well. But if not, we can leave it there. And then if you have any questions, you can always email us as the event organizer or email the speakers directly. And then if you're not following us on social media and you're not joined up to our mailing list, these are the details there as well. I don't think any questions are coming through, are they? Give it a few minutes in case anyone has any burning questions. But yeah, thank you so much for joining us today. Hope you found this session useful. I know it's a lot of information to take in, but hopefully it's given you that introduction. And yeah, the presentation will be shared. We'll send the recording and the slides over.
Okay, great. Thank you so much.
Thank you.
Thanks, everyone.
Thank you. Bye.
Thank you.
Thank
Bye.
you.
Bye-bye.
Bye. Bye.
Bye.